Hello, welcome to Advanced Financials. In this section, we'll be going over more advanced financials. First, operational cost analysis. Have you ever heard the phrase you have to spend money to make money? Well, it's true, and balancing the spending of money can be really difficult for many companies. That's why they're constantly analyzing how much money they spend in various aspects of operations. But what is the cost of operations analysis? Think of it as taking inventory, not of your products, but of your company's financial breathing room. This analysis answers one big question. If I didn't sell a single unit of product, what would I still be paying for? Now, why does this matter in your DECA project? A judge doesn't just want to see a great idea, they want to see that you understand how to keep it alive. A strong cost of operations analysis is going to show realism, that you've thought it beyond profits and looked into actual logistics, pricing logic. If you're charging $10 for a product and your operation costs $6, that makes sense, but if you ignore costs, your pricing looks flimsy. And financial connections. If you show how these expenses link into cash flows or income statements, you're good. But how do we even do this analysis? Step 1 is to categorize all costs. However, we're not listing everything at random. While your business may have additional categories depending on your focus, we'll go over the basic categories real quick. Administrative costs are those you incur to run daily business, but it's not directly related to sales or making products. Examples include permits, licenses, accounting software, etc. Labor costs are all of the costs related to your workforce, and that includes wages, salaries, payroll taxes, and anything else you pay to maintain and manage your employees. Next, technological costs are known as IT expenses, and they cover costs related to acquiring, maintaining, or upgrading your access to tech. These might include anything from website hosting, to Canva, to payment processors. Facility costs are associated with operating a business within you guessed it, facility. This might include rent, water, electricity, or Wi-Fi. Marketing and promotion costs, which include any costs incurred to promote your products or services, and can cover a bunch of different things. This might include anything from Instagram ads, to posters, to influencer costs, to the freebies you give away in a promo. And finally, production overhead costs. These are indirect costs associated with the production of goods or services, but are not directly traceable to a specific product. These include equipment, cleaning supplies, repairs, etc. Now, this is where it can get tricky. If your project involves operating a manufacturing plant in-house, you'll actually have to separate the rent from that and any office buildings. That is technically a production overhead, so manufacturing's buildings, rent, and utilities would fall under this category. As a final note, we did not cover production costs. When you're talking about cost of goods sold, those exist outside of an operational analysis. If you're unfamiliar with cost of goods sold, go check out our basic budget video. With the categories of costs out of the way, let's calculate. Step 1 is to list every line item or unique expense. For each, identify the following traits: the name of the item, the unit cost, the frequency or quantity. From there, multiply the unit cost and frequency/quantity to find the total line cost. For example, if utilities are $100 per month every 3 months, it would be $100 per month for 3 months, it would be $300. Do this for every line in every category. Next, sort your line items by calculations. Once you're done, create a table like the one on screen currently. Bold each category total and provide a cumulative operations cost. Visuals like pie or bar charts can clarify the cost breakdown. Conclude with a summary that links this total to your pricing strategy or funding plan. Also, do these bonus calculations for analysis points. Cost per unit is equal to total production cost divided by units sold. For example, $1,250 divided by 50 units equals a unit cost of $2.50 per unit. Cost per customer is equal to total marketing and sales cost divided by number of customers served. For example, $1,250 divided by 250 customers is equal to $5 per customer. These are great for explaining why your prices are fair or why you need funding. Next, we're going to talk about balance sheets. The balance sheet provides a snapshot of your business's financial health at a single point in time. That detail is incredibly important. It's organized into 3 key sections: assets, liabilities, and owner's equity. These all work together to create what is colloquially known as the accounting formula. Assets equals liabilities plus owner's equity. Assets are what your business owns, and liabilities are what your business owes. And owner's equity shows everything that's left over. This is what belongs to the owner or shareholders if the business is large enough. It's important to note that the accounting equation must always be equal. If it's not balanced, that means you have failed to properly account for all transactions. This is the biggest way students lose points in this section, often. At ICDC, this is one of the easiest methods to separate good from great financials. Remember when I said that the time aspect of balance sheet is important? For events that require a balance sheet, they're used to showcase credibility in your financial plan. Specifically, by asking you to supply a projected balance sheet for the end of your first year, your judge is trying to gain insight into the likelihood that your business is able to move into the second year. Additionally, 20% of small businesses fail in their first year, and 30% fail by the end of the second year. A well-structured balance sheet is how judges will verify your funding sources, examine startup contributions, and understand how you distribute your assets and obligations. Always start by choosing a specific reporting date that fits within the project timeline. This will always be at the top of your sheet and will be balance sheet as of date. In order to properly forecast 12 months out, we need to account for all assets. As we gather the information necessary, split them into 2 categories: current assets and long-term assets. Current assets are things like cash, inventory, prepaid expenses, or accounts receivable, whereas long-term assets are things like equipment, land, or leases. From there, forecast liabilities. Make sure to separate these as short-term and long-term obligations. A good rule of thumb is that if it'll take you more than a year to pay off, it's a long-term debt. Short-term liabilities can be things like unpaid invoices or upcoming monthly repayments, whereas long-term liabilities are closer to loans, liens, or mortgages. Finally, we have to calculate the projected equity based on your asset and liability estimates. Thankfully, this is pretty easy. First, we add the value of all assets together to find our projected total assets. Then we do the same with liabilities, summing them to find the projected total liabilities. From there, we substitute liabilities from assets to determine projected owner's equity. If this number comes out as negative, stop. That is a huge red flag. Your business is operating in a negative net worth situation, and you will be unable to leverage that in most cases to survive into the next year. You will either need to lower liabilities, raise assets, or do a mix of both. Now, assuming you didn't come up with a negative net worth when subtracting liabilities from assets, we are left with the owner's equity. If you plug these 3 numbers back into the accounting formula, they should balance. Always double check your math here. That is very important. Next, you should know your company's debt-to-equity ratio like the back of your hand. If it's too high, then it means your company is overly reliant on borrowed money, rather than making enough revenue to cover operations. Anytime your debt-to-equity ratio is above 2 to 1, this will be a massive red flag to judges. Next, when we're developing our balance sheets, always use the balance sheet to reinforce your growth logic. If you plan to end the year with $500 in inventory and $1,000 in retained cash, those values should also appear in your year-end cash flow and the cost of operations estimates. When all projections align, your financial story becomes more persuasive, which is what you're trying to accomplish at the end of the day in DECA. To wrap up balance sheets, here are some rapid-fire pro tips. Tie your cash figure to a beginning balance in your cash flow. Cross-reference equipment costs from your operations or startup funding to establish credibility. Show how liabilities link to short-term borrowing or your funding table. And use equity changes to reflect retained profits over time. Next, here are some optional advanced add-ons for a balance sheet in a top-tier project. Depreciation. For example, our laptop depreciates $100 per year, so we list it at $700 net value in year 2. Breakdown of equity. This means splitting your $1,000 into, for example, $700 in owner contributions and $300 in retained earnings, also known as profit. And finally, year-over-year comparison. This means if you're showing long-term operations, add a second column to compare this year versus last year and discuss any growth or changes. Let's look at an example balance sheet. It's been ultra simplified to represent a fictional small business. First thing we should notice is the left side is assets and the right side is liabilities and equities. We generally see these two columns side by side or stacked if we run out of space. Next thing we see is that all labels are left aligned and all numbers are right aligned. This is so if you're using decimal places, they all line up. Additionally, it uses indents for subcategories. Also, we always put current before non-current, and that applies to both columns. Additionally, if you have a negative number, it's common practice for it to go in parentheses, not to use dashes or negative signs. With that said, we're done with balance sheets. Next, we'll be talking about cash flow formulas. A cash flow statement is a financial projection that outlines how much money enters and leaves your business each month. It tracks beginning cash, monthly inflows, monthly outflows, and ending cash. The process repeats across a 12-month period, creating a rolling projection of your financial position. Use this formula to structure your monthly entries. Beginning cash plus cash inflows minus cash outflows equals ending cash. Each month's ending cash becomes the next month's beginning cash. This setup allows your business to monitor liquidity, anticipate funding needs, and plan for growth with realistic timelines. The cash flow statement shows whether your business can manage money responsibly over time. Judges will review your monthly plan to determine if your timing of income and expenses is realistic, whether you reach a point of positive cash flow where inflows exceed outflows, if you have accounted for shortfalls or seasonal dips, and whether your numbers align with your operational, sales, and funding sections. A strong cash flow statement demonstrates financial feasibility. It reinforces that your plan is achievable based on projected business activity. To prepare for calculating cash flow statements, follow these 4 steps. Step 1. Set your time frame. Structure your projection across 12 months. Most DECA projects use a January to December format. Step 2. Identify all inflow sources. List every method through which your business expects to receive cash, including product or service sales, such as unit price or quantity sold, sponsorships or donations, fundraising activities, loans, grants, or investor contributions. Step 3. Identify all outflow categories. List monthly expenses based on your cost of operations. This could include inventory and cost of goods sold, marketing and advertising, labor or stipends, subscriptions and digital tools, rent, utilities, shipping, packaging, and contingency or miscellaneous expenses. Finally, step 4. Define starting cash. Your beginning cash balance should match the funds available from launch, such as personal savings, startup capital, or loans. After you're done with all 4 steps, you can make your cash flow statements. Here's an example of a cumulative one. To make it easier, we've only done 3 months. Here, let's talk about the visual elements like how we deconstructed the balance sheet. Think column equals time and rows equals categories. As you can see here, we have 3 months that start the year, and they're all consecutive. Additionally, we've bolded our section headings and used light shadings. When we had no change to cash flow, such as with capital purchases in January, we don't put in a 0, we leave it blank. Additionally, note that every number has 2 decimals. If a single expense is in decimal format, everything else needs to match it. In that same thread, if you have a lot of very large numbers, it's okay to indicate somewhere on your chart that all numbers are in thousands. Just make sure to write it in parentheses. Once again, all negatives should be in parentheses. None on here, but worth noting. We continue this pattern through all 12 months. Update each ending cash value by adding net cash flow to the previous month's ending balance. Using a clean landscape-style table, we show monthly values with a final total column. Make sure to highlight important months using color or bold text, such as using red for low cash months that are, for example, below $200, and using green for milestones like first positive cash flow. We should always identify the lowest monthly cash point, mark when the business begins operating at a profit, and explain any high expense months and connect them to planned growth or campaigns. To do so, we want to ensure consistency between our sales revenue forecast, cost of operations, and the funding and startup capital we have. Next, a 3-year financial projection estimates your business's financial performance over a 3-year period. It tracks how your revenue, expenses, and net profit evolve as your operations expand. This projection highlights long-term growth potential, outlines key financial milestones, and reveals whether your business can remain sustainable over time. For it, include the following core elements: annual revenue estimates, cost of goods sold, operating expenses, and gross and net profit. You may also include margin growth, reinvestment plans, and break-even timelines. This section allows judges to assess whether your business can grow responsibly and maintain financial stability. Strong projections should reflect realistic and industry-informed growth rates. Judges can tell when you're not basing these in reality, and saving money in your budget isn't worth docked points. Align with your brand, marketing, and operational strategy. This is pretty basic. If you have money, great. If not, you need to adapt your business model too. Shows year-over-year increases in profit and strategic use of capital. Basically, are you getting better every year at managing your resources wisely? And finally, demonstrates awareness of future risks and resource needs. This is more aligned to risk and quality management than anything, but we show it in a 3-year plan often by setting aside increasing amount for contingency plans or with oversight and management expenses. Judges are looking for a structured narrative supported by numbers. A successful projection is going to have to do more than add revenue. It shows how growth is achieved, when and how scaling is going to occur, and even how profit is allocated or reinvested. Generally, if you're trying to think of strong projections, you can apply projected growth patterns to start when drafting. Revenue might increase 15 to 30% annually, depending on your market size and strategy. Cost of goods sold increases in total, but may decrease per unit due to bulk pricing or efficiency. Operating expenses, such as labor and marketing, increase with scale. Fixed costs like software or subscriptions often remain stable. Here's an example. As we can see here, time is once again columns and rows are categories. There's quite a few different ways to visually chart 3-year financial plans. This is just one we pretty commonly see. Margin should improve each year if growth is paired with smart cost control and reinvestment. Generally good for table presentation. Use clear row labels and year-by-year columns. Bold the net profit row to draw focus. Include margin rows or annotate key shifts. Use the following formulas to calculate margins. Gross margin is equal to revenue minus cost of goods sold divided by revenue times 100. Net margin is equal to net profit divided by revenue times 100. Let's talk about strategic focus. We want to make sure each year we have a natural progression that makes sense given our budget. This is something that evolves with your budget, and a chart here is a fun complementary thing to include. However, it's also good to be very clear with your allocation within your budget. This should match your budget elsewhere, and you can also do it in a pie chart if you'd prefer. Here, we provided some basic percentage breakdowns. In that same vein, however, it's always good to look at risks and response strategies. We went with a basic chart format here, but you can do whatever works best with you. We go more deeply into this in risk and quality management if you're interested in learning more. When we're looking at 3-year financial plans, we want to call attention to the following: year-over-year growth in net profit, when the business reaches profitability, what will be done with retained earnings or excess cash. For example, we intend to reinvest 70% of profits and reserve 30% for stability and scalability. Your break-even should always connect to earlier calculations. Our break-even point occurs in month 5 of year 1. After that, each month contributes directly to net growth. Once again, thank you for supporting us.